Welcome back to MF Corner on CNBC TV18. And like we mentioned before, we're going to be focusing on investing in international markets via Gift City. Now, this recent time, we've seen a couple of funds actually being launched here. PPFFAS has launched two funds coming in here. One is the S&P 500 fund and the other one is a Nasdaq 100 fund. Obviously, they are tracking the US markets. Apart from that, there is a Baroda BNP Paribas AMC, which has launched a Gift City fund investing in US small caps as well. So obviously this offers direct access to US small cap market. Now, what are the risks? What are the advantages? How should you go about it? Does it make sense to go via this as well? Let's continue this conversation now with Varun Fatehpuria. We have with us who's from the founder and CEO at Daulat Finvest as well. Varun, obviously we've spoken about Gift City investing in the past as well. But if you could highlight the key advantages that come in here for an Indian investor seeking to invest in the international market, the diversification that you want over there. And obviously, there are a lot of talks that come in terms of the perception of tax-free also. Is that the case? What is the scenario in terms of taxes here as well?
So, Vinnii, I'll take the first question first with respect to one of the biggest benefits and why Gift City funds today are in an investor's radar is because for all intents and purposes, the $7 billion cap at the industry level has been hit, due to which a lot of investors like us are unable to invest through the traditional mutual fund route, right? So a couple of years back, you could just passively invest in an S&P 500 or a Nasdaq 100 through the international mutual fund route. But today, because the cap has been hit, investors are forced to choose the Gift City fund route. So one of the biggest advantages today, instead of directly investing in US stocks or any of the global stock, is the familiarity and a regulatory framework through which you can actually invest. So think of it as similar to SEBI, but the Gift City regulator, IFSCA, provides you with a very traditional and a formal framework through which you can actually send your money outside of the country. So while physically Gift City is still located within India, technically it is an offshore jurisdiction. So when you're investing in Gift City, you're actually sending money outside the country. So that is one of the advantages. Second, with respect to, I would say, taxation. So most of the funds in Gift City today are structured as a trust, right? And as a retail scheme today, since it is set up as a trust, the taxation incidence is at the hands of the trust. So whenever investors actually redeem their funds, they are redeeming at a post-tax snap, which investors need to understand compared to, let's say, a traditional international mutual fund route, where the tax incidence actually lies in the hands of the investor. The tax is already accounted for at the Gift City fund level. Okay. So whatever the investors receive is at a post-tax snap.
Also, you don't have to pay the tax collected at source, right, which was announced earlier, and that also brings in a lot of liquidity, which you would do otherwise if you're investing directly in international stocks. But there are, of course, risks which would be involved, right? People are looking at Gift City also because there are limits to how you can do it directly via international funds. So what are some of the risks that investors should be aware of when they're investing via Gift City in these fund of funds?
So I would say, Sonal, I think less of a risk and more of a structural novelty, in the sense that people are less familiar with respect to how to actually send their money outside of the country. So if I were to invest in a plain vanilla international mutual fund, I could probably just do that with a couple of tap of a button, and that is relatively straightforward. Today, if I'm investing through an LRS route, I need to first make sure the currency conversion happens at an appropriate rate. Then my bank needs to actually send that capital to the AMC unit in the Gift City, which further then invests that in the international markets. That number one. Number two, these funds are actually dollar denominated. So when the redemption proceeds actually come into your bank account, they come in US dollar format. So this could actually be a very well way to actually build a certain amount of dollar asset over a 3 or 4 year period, if you're able to utilize the 250K limit which the LRS allows. So no risk per se, apart from the traditional or the standard international investments risk, which anyway you are exposed to, whether you're investing through Gift City or you're investing through an international mutual fund.
Okay. Varun, what kind of investors are best suited for these international fund of funds or investing via Gift City? And obviously, this will be considered as a satellite allocation, right, in their portfolio?
So we always advocate that people need to build maybe anywhere in the range of 15 to 20, 25% of the overall portfolio for international allocation. But having said that, yes, I think it really depends from individual to individual, investor to investor, based on what the risk appetite is. So Vinnii, I think all said, investors could look at allocating to that range, because today we are pretty much have a very strong bias towards our home country. So almost all of our assets, whether we are working or have a business, are actually invested in the country. So actually taking that away and putting that aside from a small pie perspective into the international markets could actually be a very well strategy to hedge your exposure, number one. And number two, given the depreciation of INR against most of the global currencies, this could also be a very well way to hedge your international currency risk, where if the INR actually depreciates, you stand to benefit more.
Okay, all right. So people who are investing right now must be benefiting from the rupee depreciation that we saw in the last 15 days. Two-part question here, Varun. One, would the investment via Gift City be costlier for an investor? Also asking because we've seen these changes in total expense ratio now, right? And how should investors balance their exposure between Indian and international markets using the new products?
So today, Sonal, most of the number of investment options today available in the Gift City are fairly limited. So if I want to categorize that, there are retail schemes and non-retail schemes. Retail schemes start at about $5,000 at minimum, compared to, let's say, an international mutual fund route, through the onshore route, where you can invest as low as 500 or 1,000 rupees. But the expense ratio that we have seen today, anywhere for regular plans, are in the range of 1.5 to 1.75%, definitely higher than what you would see in the domestic markets for passive exposures, right? So yes, definitely from a cost perspective, if you're looking to get an active exposure to the global markets through the Gift City, the TER is slightly on the higher side compared to international mutual funds. And just on your second question.
Yeah. Yes, go. I'm sorry. You were saying something, Varun?
No, could you just repeat your second question?
Yes. I was just saying, how can one balance their domestic and international exposure via these products? Because you do have to have a balanced portfolio, right? So how does one go about that?
So I think typically, again, as I mentioned today, most of our investments are biased towards the Indian domestic equity markets. So we always advise clients that you start small and maybe take a 7 to 10% exposure to global markets. Maybe US is the most familiar destination. And obviously, given how the US markets or most of the other emerging markets globally have performed over the last year and a half, with the AI boom, which is actually taking place, right? Then maybe I think once you become familiar, you understand what are the risks involved, you could obviously dial that exposure up to 15 to 20% of your overall portfolio. So it gives you a more balanced portfolio, given the Indian equity markets have not really performed over the last 15 to 16 months. So if you would have had international exposure, at least a certain part of your portfolio would have been hedged.
Right. Varun, you did mention, right, that the amount at the start, when you do start investing in this fund, is going to be $5,000, if I'm not wrong, right? That's what you said. So when you're investing in these funds, whether it's a PPFAS, S&P 500 or the Nasdaq 100, there will be a lump sum amount that goes. And then is there a minimum amount for SIP that you have to go through every month as well? How does that work?
That's right. So the minimum initial contribution amount is $5,000 for most of the funds that we're talking about, whether it is the DSP Global Equity Fund or the PPFAS S&P 500 Nasdaq 100 fund. And once you have made that $5,000 contribution, then you can make an ongoing contribution of $500, which is closer to 45,000 rupees in current exchange rate. So definitely, yes, slightly on the higher side compared to most of the mutual funds that we are familiar with, but definitely not out of the reach of people.
For HNIs, according to you?
So HNIs also today have a Cat 3 option where they can invest about $150,000. So the Baroda fund that you talked about initially, so that is actually a Cat 3 AIF where the minimum investment amount is $150,000. But that could be brought down to about $10,000 if you are an accredited investor.
Thank you so much for explaining that to us so comprehensively. So that's all about investing in Gift City or international funds via the Gift City route. Thank you so much with your insights today. With that, we'll do one thing. We'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.